Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, welcome to today's edition of Cut to the Chase. Today is Wednesday, the 5th of August, and my name is Fook Hien. August has started well for equities with the US benchmark S&P 500 index making a new all-time high yesterday, surpassing the previous high back in early June. Now, August may seem like a strange month for the market to make a new high, as historically, the average return for US equities in August is quite muted. It actually looks like the rally that was supposed to happen from July has been delayed. July historically has a strong average return, but this year the S&P 500 was down slightly in July, which is a rare event, making it the first negative July in a decade. So what drove US equities to a new high yesterday? Positive headlines from President Trump that a deal is imminent with Iran certainly helped. The volatile situation in the Middle East has actually been causing inflationary fears in the month of July, with the US 10-year yield rising through the month of July, going above 4.7%. Long-term rates need to be closely monitored, as our backtesting has shown that for every 25 basis points increase in the cost of capital, equities face a potential valuation impact of 3 to 4%. Now, news about de-escalation is bringing yields lower, which is positive for equities. The good news also is that we believe earnings growth will have sufficient buffer to drive equities higher despite any adverse impact from higher rates. More than 60% of the companies in the S&P 500 index have reported the second quarter earnings now, and 85% of them are beating earnings expectations, which is an excellent result. Historically, on average, about two-thirds of reporting companies tend to beat on earnings, so 85% now is a great result. The US is on track for more than 30% earnings growth this year and about 15% earnings growth next year. For the month of August and the next few months up to the US midterm elections in November, history also teaches us to expect higher volatility. Based on historical data, in midterm election years, equity volatility in the months of August, September, and October tend to be higher than average. In summary then, that's three things to watch out for in August that can impact equities. Watch long-term rates, and linked to that is the Middle East conflict. Continue to monitor the Q2 earnings season, and watch out for US election-linked volatility. Our bias, though, is to use any weakness to add exposure to US equities, which is one of our overweight markets, with our view driven by the strong and visible earnings growth. Even from current levels, we continue to see upside to US equities, and especially in the Nasdaq index, where we see about 10% upside still. Nasdaq is heavy in the technology sector, and that is an area we continue to like, with strong earnings driven by AI investments. That's all I have for today. Thanks for listening, and I look forward to chatting with you again soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.